Class, and welcome to your Chapter 4 Knowledge Check. So far we've looked at service companies and we talked about revenue, expenses, and our income statement. We subtracted our expenses from our revenues. That gave us our net income. For Chapter 4, we're going to start looking at merchandising companies. So we're actually going to start looking at companies that resell items. So they buy items and they resell them to the public. So when you think of your supermarkets, you think of your Macy's and other companies such as those types of operations. That's what we would consider merchandising companies. Some things to note. Again, service companies, we looked at revenues minus expenses, which gave us our net income. In a merchandising company, it gets a little bit more complicated. We're going to look at net sales, which encompass our sales minus any sales returns. So think of when you buy something from Macy's, you don't like it and you return it. That's a sales return. So you have your sales, you minus your sales returns, and that gives you your net sales. Sales discounts also are subtracted from sales. So when again, thinking of Macy's, when you um, buy your item and they give you a discount on it, that's called a sales discount, and that's also subtracted from your gross sales to give you your net sales. You subtract what we call cost of goods sold. So Macy's bought those items from somewhere else at a cost, right? So let's say you're buying a shirt. Macy's paid $5 for that shirt from maybe a manufacturer in China, and then they sell it to you at $20. All right. That $5 is what we call cost of goods sold. And we subtract that from our net sales amount, and that gives us what's called gross profit. From our gross profit, similar to a service company, we then subtract out our expenses, and that gives us our net income. A few other things I want to point out for this chapter. Again, going to keep it brief because you have more extensive videos for this course. However, when you purchase inventory, you would debit a merchandise inventory account because that's an asset. You now own these goods. These are an asset to your company and it's called inventory. You debit a merchandise inventory account and you credit a cash account. Now, if you buy them on credit, which means you still owe the person, you would debit your merchandise inventory account and you would credit an account payable account. Okay? Let's see what else we should cover here. Now, when you make a sale, there are four different transactions that are involved with making a sale. Let's say we made a sale on for cash. What you would do is because you're receiving money when you make that sale, you would debit your cash account and you would credit your sales account. Now, because you are selling an item, you're a merchandising company, you're selling an item, you need to account for the fact that that item is now no longer yours. You no longer own that item because you sold it. So what you need to do is you would debit an account called cost of goods sold, and you would credit your merchandising inventory or your merchandise inventory account to show that that item is no longer in your inventory. So those are some of the transactions that you will look at for chapter 4. Thank you. If you have any questions or if anything seems puzzling or you need help, feel free to reach out.